Hello everyone, Alex Kim here. What just happened in the silver market wasn't a normal pullback. This was forced liquidation colliding with structural demand, and if you don't understand the difference, you'll misread what comes next. It's Tuesday, February 3rd, and we need to talk about three things that happened simultaneously: a sharp sell-off in paper metals, China's accelerating reserve currency push, and a silver product in China hitting an emergency trading halt. These aren't separate stories, they're connected, and the connection reveals where the real pressure is building. Let's start with the sell-off itself. Silver and gold got hit hard, but here's what most people are missing. When a market is truly finished, it doesn't need a complicated excuse to fall. It just falls and stays down. What we saw instead was violent selling followed by immediate attempts to recover. That's not exhaustion. That's liquidation. The difference matters. Exhaustion means leadership fails, the strongest assets stop acting strong, and rallies can't hold. Liquidation means leveraged positions got forced out while the underlying bid remained intact. Watch how the market behaved into the close. Did it collapse and stay collapsed, or did buyers show up without announcement? That hesitation tells you something. It tells you there are still buyers underneath, testing whether the foundation holds. This is not a retail story. Now look at the mechanics. Margin requirements at major futures exchanges went up during peak volatility. When margins rise, leveraged traders must post additional cash immediately, or their positions get sold automatically. That creates cascading selling pressure that has nothing to do with fundamental demand. It's mechanical, not structural. And here's the critical part. While paper prices were getting hammered in New York, the premium that Chinese buyers were paying for physical silver stayed elevated. If demand were truly collapsing, that spread would have collapsed too. Instead, it widened. That's a loud signal. The bid hasn't been satisfied. The paper market tried to drag physical lower, and physical didn't fully comply. This brings us to China's currency ambitions, which are accelerating faster than most people realize. China doesn't need to replace the dollar overnight. It just needs to create optionality for countries that want to reduce dependence on dollar-denominated settlement. That's exactly what's happening. Reserve diversification isn't about rejecting dollars entirely. It's about holding neutral assets that don't carry someone else's policy risk. Gold becomes valuable in that environment because it can't be frozen, it can't be sanctioned, and it doesn't require permission from a central bank to hold or transfer. When countries stack gold reserves, they're not making a bet against one currency. They're buying insurance against systemic fragmentation. And silver sits at the intersection of that monetary shift and industrial necessity. Solar installations, electric vehicle production, 5G infrastructure, defense systems, all require silver in quantities that current mine production cannot meet. Supply deficits have been running for 5 consecutive years. Above-ground inventories are being drawn down to meet industrial demand, and there's no quick supply response because silver often comes as a byproduct of other mining operations. You can't just turn on a silver mine like a faucet. This isn't speculation. This is positioning. Now here's where it gets uncomfortable. A silver-linked product trading in China hit an emergency halt because premiums and volatility spiraled out of control. This product is long only, meaning you can't short it to arbitrage away the premium. When you can't short something, it can trade at irrational levels, attracting flow from participants who don't have access to other channels. That creates a pressure cooker. When that pressure releases, it doesn't stay local. It leaks into global pricing, especially when it coincides with margin hikes elsewhere. The timing wasn't coincidental. Margin increases in New York forced liquidation, just as China's product freeze cut off a major demand channel. The result was a violent repricing in paper markets, while physical bids remained firm. Are you seeing the same pattern in other commodities? Or is this dynamic unique to silver's dual role as both industrial input and monetary asset? If you find this breakdown useful, consider subscribing so you can track how these structural signals develop. Let's talk about what this means for positioning going forward. The key question isn't whether silver can drop further. It can. The question is whether the underlying structure has changed. Has industrial demand weakened? No. Solar, EV, and infrastructure demand continues growing. Has mine supply increased? No. Lead times remain over a decade for new production. Have central banks stopped diversifying reserves? No. Gold purchases remain at multi-decade highs. What changed on Friday was leverage, not fundamentals. Leveraged positions got cleared out. Stop losses cascaded. Margin calls forced selling. But the structural deficit, the industrial demand growth, and the reserve diversification trend all remain intact. That's why I'm watching behavior rather than individual candles. Does gold recover quickly after sharp hits? Does silver hold prior breakout zones on a closing basis? Do mining equities stop bleeding and start outperforming again? Those behaviors tell you whether the trend is broken or just resetting. The dollar also matters here because dollar strength mechanically pressures commodities priced in dollars. The dollar index firmed up following the Kevin Walsh nomination as Fed chair, which was initially interpreted as hawkish. But if you dig into Walsh's recent statements, rather than just his 2011 resignation over QE2, his stance appears more dovish than the market's first reaction suggested. If that view shifts over the coming days, dollar strength may fade, which would remove pressure from metals. Watch the flow, not the headlines. Here's the broader macro picture. The US is running enormous fiscal deficits, and the cost of financing that debt swings with yields. When yields stay elevated, the interest expense becomes a political problem. Historically, when that tension builds, policy leans toward financial repression, keeping nominal rates contained while inflation runs hot enough to erode debt in real terms. That environment is one of the most supportive setups for gold and silver over time, not because metals are magic, but because they're alternatives when cash loses purchasing power quietly and bonds fail to hedge stocks during inflationary regimes. This is the regime shift worth watching, not daily volatility. Now let's address the physical versus paper disconnect directly. Silver supply isn't just about mining more. A significant portion comes as a byproduct, which means supply doesn't respond elastically to price signals. On the demand side, investment demand is emotional and can fluctuate. Industrial demand is contractual and sticky. Manufacturers can't simply wish silver into existence when supply tightens. That creates a floor under long-term pricing. When paper markets sell off violently while physical premiums stay elevated, it signals that paper leverage was the problem, not demand destruction. This is exactly what we're seeing now. Chinese physical premiums didn't collapse during the sell-off. They widened. That's the clue. One more thing about derivative products. When you stack a wrapper on a futures contract on a spot market, you're not building a stable investment vehicle. You're building a volatility amplifier. Long-only products that can't be shorted create conditions where premiums spiral, crowds get trapped, and when the system gets stressed, it responds by halting trading or raising margins to restore order. That's not conspiracy. That's how stressed systems behave. Whether it's engineered or emergent doesn't matter. The outcome looks the same. Let me be clear about what I'm not saying. I'm not saying silver can't go lower. I'm not saying this volatility is over. I'm not saying you should rush out and buy anything. What I'm saying is that the character of this move looks like forced liquidation in a structurally tight market, not the beginning of a sustained downtrend driven by weakening fundamentals. History shows that sharp single-day crashes in silver have been followed by recovery more often than continued collapse, especially when measured over 6 to 12-month horizons. That doesn't guarantee this time follows the pattern, but it establishes the base rate probability. The ingredients for further upside remain in place: supply deficits, industrial demand growth, reserve diversification, and a macro environment where financial repression supports hard assets. What got cleared out was leverage, not the thesis. So here's the framework. Watch whether regional premiums stay elevated during overlapping trading sessions. Watch whether miners regain leadership after the initial shock. Watch whether key breakout levels hold on a closing basis. Watch whether the dollar rally is a short squeeze or a sustained trend. And watch whether China's silver product reopens with calm trading or immediate premium expansion. Those behaviors will tell you whether Friday was a scare or a structural break. The rope between paper and physical is stretching. Something will give. Either premiums collapse because demand gets satisfied or suppressed, or paper price snaps higher to meet physical reality. That's the tension worth monitoring. How do you interpret the gap between paper liquidation and persistent physical premiums? And what does that tell you about where the marginal buyer is positioned? Drop your thoughts in the comments, and I'll continue tracking how this structural divergence resolves over the coming sessions.